Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Here's your U.S. markets wrap with me, Ryan Huang. And taking a look at Wall Street, we've got some green on the screen, just barely. The S&P 500 up 0.3% to 6,280. And the tech-heavy NASDAQ squeezing out a gain of 0.1%. And the Dow up 0.4%. And this comes as investors shake off any worries about the latest trade developments. The latest involving a 50% U.S. tariff on imported copper, as well as a 50% tariff on Brazil. So let's check in now with Gina Martin Adams. She is the Chief Equity Strategist and Global Director of Equity Strategy at Bloomberg. Gina, good morning. How are you doing these days?
I'm well, thank you. How are you?
I'm doing good as well. Now, Gina, markets have been doing pretty well. We've been seeing record highs. The NASDAQ has been helped by some of the big tech names. And you've been watching very closely how the earnings season's going to be playing out. So we've just got Delta's numbers out. And it looks like they are looking quite optimistic about the rest of the year. Walk us through. What are you expecting on that front?
Yeah, I think it's going to be a really interesting earnings season on a number of fronts. The most important thing to watch is actually not necessarily what happens in the second quarter, because the analyst community is expecting so very little of companies, but how companies guide us toward the rest of the year. Second quarter earnings expectations have dropped tremendously from just a few months ago. Analysts are now anticipating just under 3% earnings growth for S&P 500 companies. That'll be the slowest earnings growth we've seen in more than 2 years. And that is as a result of analysts' reactions to the trade policy announcements in April, which has since been walked back in fits and starts. We're experiencing new trade policy news this week. But generally, I think we're set up for a big beat on the second quarter. The big question, though, remains what happens in the second half of the year, because the analyst community is expecting a rebound. And I think the companies will have to give us some confirmation of that to claim that this is a very successful earnings season over the next few weeks.
Yeah, I think the word tariff was one of the more cited words in the recent quarter's commentary. And of course, closely watch as well as you see this back and forth going on. Okay, taking a look at how that could play out on the tariff front. We've also seen a bit of pressure on the US dollar. Where do you see it going for the currency, and how is that going to impact the earnings season?
Yeah, luckily I only really talk about equities, but I will say our currency strategists see the longer-term outlook for the dollar as continued depreciation. So if that does indeed come to play, it would likely benefit the most international components of the index relative to the most domestically oriented. What you see is the tech companies, the materials companies, to a lesser extent industrials companies, and some consumer stocks tend to be most sensitive to the dollar because they do have a significant portion of their profits earned overseas. So a weakening dollar would help their revenue growth prospects outside of the United States, at least when they are translated back into dollars. The problem with the weakening dollar is probably more important to watch right now because it exacerbates elevated input costs. And obviously, tariffs also risk increasing the cost of inputs, albeit, in the short run. Tariffs operate like a tax on company profits because they do increase the cost of importing the goods. Now, the companies can obviously try to pass those costs on to consumers, but let's assume that some of that cost does get absorbed by the company. They then also have a weaker dollar to pay for those imported goods, and that results in some degree of import cost acceleration for the big importers. So it favors exporters over importers. Generally, that favors large caps over small caps if we do see the dollar resume its weakening trend.
Yeah, a couple of things to unpack there. One is technology, and the other part is what I mentioned about costs being passed on. What is the appetite or the ability for consumers to absorb higher prices down the road?
Yet to be seen, really. The consumer spending pace has been relatively steady, but at a fairly weak level. Consumers are certainly slowing down their purchases of big, heavy, durable items that they have to finance because it is more expensive to finance than it was in recent past. They also are seeing, relatively steady income growth, though, because the job market has remained fairly stable. And so that's helping maintain a reasonable degree of spending. They're spending a lot more on services than they are on goods, and goods tend to face the import cost pressure. So what you probably see is a continued divergence in favor of services spending, in favor of experiences, over goods spending, where the bulk of the price increases probably occur in the short run.
Okay, and you pointed out how the weakening dollar could be beneficial for some of the big tech names. We also have tailwinds with the AI boom. We've seen NVIDIA break a new high recently, breaking the $4 trillion mark for market cap. What's your view on how priced for perfection it is right now, or overpriced in that sense? Is this the time to get in still on these AI names?
Yeah. It's a good question. It is very expensive to get access to that trade, obviously. That is the most beloved trade in the S&P 500, with the exception of defense, which has done very, very well, not only in the U.S., but globally this year. And so the tech trade is definitely powering elevated valuations. I think you have to take a longer-term view with this, try to find opportunities to get in when investors are getting out. Luckily, we have found a point in time where tech rotation has started to occur again just after NVIDIA made its all-time high. Tech did lag the market rebound today, and may be one of the sectors to watch most carefully for weakness emerging with this earnings season. I say that because the tariffs as proposed this week inordinately operate against tech. And if you think about who has the most supply chain exposure in the S&P 500 to countries like Japan and Korea, for example, where 25% tariff has been proposed, the tech companies have the most exposure to that. So tech companies on average get about 10% of their inputs from Japan and Korea, whereas the index at large gets about 5% of the inputs. So tech is going to have to contend with that, as well as an elevated price of copper, thanks to tariff proposals in that space as well. So we'll see how tech navigates that increasing cost of inputs in a point in time when they're obviously also spending a whole lot on driving the phenomenon that is AI proliferation through the broader economy.
All right. You mentioned also, Gina, about the rotation in the portfolio. What are the potential concentration risks that you're seeing right now, especially when you hear about narratives like fund managers overseas trying to reinvest in their own markets away from the U.S.?
Yeah, but very clearly still, even with the first half rotation that we started to see, the broader global investment community is well overexposed to technology as well as U.S. tech specifically. Those were the big trades that dominated not only the last year or so, but really the last several years since the market lows in 2022. That's the space that has benefited the most from the uptrend. It's resulted in a tremendous amount of concentration in the form of 40% of the S&P 500 is market cap is now in the tech, media, and telecom space. 65% of the global equity benchmarks is concentrated in the U.S. segment specifically. So investors very clearly, by putting capital to work in the benchmarks, have become extremely overexposed to these themes. And that's not a bad thing as long as those themes are working. It's a terrible thing when those themes start and stop working. What is very interesting about what's happened this week is markets are still higher even though tech is lagging. And that can give you, if it continues, give you a little bit of sign of hope or at least some solace that the concentration risk can resolve itself through rotation into some of the more beaten down valued styles, small caps, non-tech segments of the index, which are still, frankly, reasonably valued, if not cheap, relative to long-term average. So we'll see if we can get a little bit of that rotation to resolve that risk, alleviating what could be a lot of idiosyncratic risk in investor portfolios because of concentration.
All right. We might get a bit more clarity with the earnings season in the next few weeks. We've been in conversation with Gina Martin Adams. She is the Chief Equity Strategist and Global Director of Equity Strategy at Bloomberg. Gina, thank you so much for your time and insights. Always great chatting with you. Thank you so much for your time.
Thanks. You too. Bye.
Right. Bye-bye. Catch up with you again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.